Now, in this video, I'm going to talk about President Donald Trump plans on this 50-year mortgage. And I'm going to talk about under his administration with Freddie Mac and Fannie Mae dropping the credit score requirements of that 620 credit score and now removing those limits in the home buying. So in this video, I'm going to break down my take and I want to get you guys' opinion. What do you feel about a 50-year mortgage? Do you think it's a good thing or a bad thing? I myself, I feel like you can work this to your advantage, believe it or not. And I'm going to break down the details of this because I'm a real estate investor and my take on how to use this to your advantage in this video. So if you like credit information and content, subscribe to this channel. And if you go to my website, you can get this free heart inquiry removal package for free at my website. The link is in the description of the video and in the pinned comment section. Now, with Donald Trump plan of that 50-year mortgage, what's intended for it to do is to make people be able to qualify for homes. Now, I don't think this is horrible. I see a lot of people losing their mind, and I understand why. Of course, if you had a mortgage, most of your mortgage front end of that is paying at interest. So a lot of that mortgage, with that 50-year mortgage, 20 years in, you're paying off the interest because it's front loaded and you really are not getting at that principal unless you are going after those principal payments and sending it into your mortgage company. But people, let's think about it like this. If that 50-year mortgage qualify you, in real estate investing, we always say control the asset. So if you can actually get control of the property, it's not bad. You just refinance down the line. Most people do. When the market open up and give you an opportunity to get a lower interest rate, even with people with a 30-year mortgage, get a lower interest rate. Most people do over the life of that loan. And no, you wouldn't stay in the 50-year mortgage. I would tell you don't stay in the 30-year mortgage. You want to pay down at the principal to pay it off early so you can save on money. Another option you need to think about if you're a first-time home buyer, going with the multifamily property. That's what I did. I was a single mom at the age of 21. I understood for me to qualify for a better school system, better area, I went to a multifamily for my first purchase to use FHA to put 3.5% down, a lower amount down versus going conventional where you got to put 20% down. And I never paid for a mortgage out of my pocket in my life. My tenants always paid for me because then when you buy a single family home down the line, your tenants will be paying for your mortgage. They're paying for your mortgage if you buy the multifamily and you're living there. And it allowed me to save up to put some extra cash in my pocket. A lot of people complain about PMI with FHA. That's a mortgage-backed insurance. So the government make you pay an insurance every month on your mortgage and they put it in a fund. And this way, this helps you get approved as a first-time home buyer because they're telling the banks that's lending to you, if this person default, we guarantee you're going to get the money back on that loan. So they make you pay an insurance every month. But with that PMI, once you refinance, y'all guys, you get that money back. That's how I bought my second rental property at 25. I refinanced with my local credit union, got my PMI money back, and I put it down on a second multifamily. So that was part of my down payment. So that's the way you need to look at it. And so when you look at getting a multifamily starting off instead, the income of those units without you even owning the home, they equate part of that income to your income and the going market rent around there. Now, they might only take a percentage, down through the years when I was investing, 2006, they was giving you 100%. Okay. That go to your income. Then when I first bought, it was about 75%. So even if it's 65%, they're going to add that to your income from the rip without you even owning the property. And that might be the doorway to get in. So you don't have to stay in the 50-year mortgage. If it helps you qualify to get your foot in the door, go on and refinance it down the line. Most people do refinance when the market get better. They got equity. They refinance, take money out. I'm not saying to do that, but who say you got to stay there? You just got to focus on your game plan. Like, remember, with rent, you're getting nothing in return. You're not gaining equity. You're just throwing money away. The thing about controlling the asset, unlike a car, a lot of people finance, the car company holds the title. The thing why it's so hard to get a mortgage, you actually get the deed. Okay. The home is yours. The lien is on the home. Where people say going into foreclosure, that's a lien. But if you get someone else or pay it off to satisfy it, the home is yours. You have the deed to the property. So you want to think about it for your goal. And what you might want to do is even consider a game plan of buying land. And maybe if you guys can buy land, then you can leverage this opportunity to afford to build with a construction loan and rolling it into something permanent later on. So you might want to think about different options. This might help you with affordability and actually consider your location and the type of property. So going with location, understand with your monthly mortgage payment with affordability. If you're in a place like New Jersey, where I work, that's you're looking at higher property taxes. That goes into your monthly payment. Insurance costs. If you're in a place like Florida, your homeowner's insurance is going to be higher. That factors in. So a 50-year mortgage may get you in the door for more affordability if you're in these places with these higher numbers, or you have higher home prices like New Jersey. The home prices ain't dipping that much in New York City and maybe even in places like California. So you might make it where you can afford. So you just have to look at your game plan. Okay. You got to understand what your situation is. Is it going to make you more affordable? The other part is dropping the requirement for the actual credit scores. So that in itself, you have to look at your own situation. Keep in mind, it's not that they don't matter. Okay. So don't think it's saying you could still actually get this. It's not a hard no if you had a 620 credit score. That's what they're saying. It's not a hard no, but don't think it don't matter. So going to those credit scores, it is going to still dictate. If you got lower credit scores, you're going to pay a higher interest rate. Interest rates is already pretty high, like 6.25. It's still, that's high, baby. When I got mine, it was like 4%, 3 to 4%. So, I believe the first home I got, it was a little higher. I might have paid like 5%. I got to remember, because I told y'all I refinanced out, but now I'm about 4%. So I ain't financing out to take no money out and no 6.25 mortgage. You get what I'm saying? So you got to look at the interest rates. Your interest rates is already high. You got bad credit. They going to qualify you, but if the interest rate, because they're going to charge you not a little more, a lot more. And you might have to pay more in points and other fees. And then monthly, it might kick you out the game because your credit is still bad, because your interest rates that you got to pay is higher and unaffordable. So all of that to say, baby, you still need to fix your credit. Okay. So you can have less that you're going to pay in that mortgage, especially if it's a single family home. You want to fix your credit. It's going to cost you less monthly. Okay. So with my elite credit systems, users like Sean, he was able to go from a 612 credit score all the way up to 770 in a matter of 6 months. And now he's at an 803 credit score. So it don't take all day. It just take a little effort. If you need my help with my AI software and credit coaching, the link is in the description of the video and the pinned comment section. And that alone, by improving your credit score, can save you hundreds of thousands in that mortgage. But even if you refinance out, that you can actually put more money in your pocket. Okay. So you want to think about that strategy. Now, if it's a multifamily and somebody else might be paying for it, and you got lower credit scores, that'll get you in the door. But also remember, with lower credit scores, they're going to want to see more reserves. Some of these mortgage companies, some of these banks want to see that you have that monthly payment of 3 to 4 months, and I'm hearing even 6 months on reserves after you paid for your closing costs and down payment. Just to give you an idea, I bought my first home at 169,000. My down payment was with FHA about 3.5%. I believe it was like 6,500, but the closing cost was another $6,000. So going to the closing table, I had to have about $12,000, and they wanted to see 3 months of reserves of my payment. Back then, I think my mortgage was about $1,600. And somebody might say, wow, that's cheap. Back then it wasn't. It's never going to be affordable when you first go in. I remember my first tenant rented my 2 bedroom in that property for about $1,000. So it was higher. Okay. A $1,600 mortgage. And now people are paying that for rent. So that's another thing that you have to think about when you're buying a home. Initially, your mortgage payment always going to seem like, dang, this is high. But because of inflation over time, guess what? You're going to win in that situation if you play your cards right. So hopefully this information was helpful. If you have any questions or comments, leave it in the comment section. More detailed questions for me, you can go to my website and all your questions go directly to my cell phone. I hope to see you guys in the next video. Stay tuned.